Hello everybody, this is Eddie Ghabour, owner of Key Advisors Group. Please subscribe to our YouTube channel for up-to-date market calls, as well as our economic outlooks and educational videos that we try to push out every week to try to help you and your families make sound decisions for what you think is best for your future. Today I want to spend a little bit of time as we head into the summer months and discuss why, in our opinion, the volatility going into this summer, more than likely based on our market and economic thesis, is going to really increase quite a bit. Okay, what we're seeing right now is a little bit of a bear market bounce. You got the VIX back into the mid-20s, and this is very typical when you see bear markets that are trading like bear markets, and that's what we think that we're in. That's our opinion. We've been saying that since the beginning of the year, and we have not changed our consensus. If anything, the data is continuing to support that things are going to get worse here in the summer months, as I'm going to get into. So, in our opinion, you have to be careful for some of these bear market traps, as we like to call them. When you see that VIX really start to come down, markets start to show a little bit more positive sign. And look, we know we could be wrong, and this could be the start of a new bull market. But we've seen this before. You look at other time periods like 08, 09, 2018, you look at different time periods where the markets were selling off, you will get these bounces. And many times bear market bounces are actually more violent than bull market bounces. And so that's a lot of what you're seeing right now, in our opinion. And here is why we have a very strong conviction that going into the summer months, this market is going to get worse before we can feel comfortable from a firm standpoint of trying to start dipping our toes back into the higher risk assets, because we're about as defensive as we've ever been in our career for our clients. So first thing I want to touch on is the dollar. You know, the dollar is extremely strong right now. And there's a tremendous amount of companies that depend, they're multinational companies, right? They depend on money from overseas, demand from overseas. You look at a country like China, right? There's a huge amount of revenue that comes from a country like China. They're in a lockdown or semi-lockdown right now in parts of their country. So you have that, which in our opinion is going to hurt demand for the multinationals, plus the strong dollar. There are not enough people talking about that relationship with the dollar and what that could do to earnings. So basically, when you have a strong dollar, that means that the international money can purchase less, has less purchasing power of our goods and services here domestically. So when you have that with a combination of a consumer that's already getting hurt with inflation, that's a double whammy for those multinational firms. So the dollar is one of the things I wanted to highlight today, and we think that's going to be reflected in second quarter earnings. And that brings me to my next point. We believe you're going to start to see more and more companies start to revise earnings down before they actually report them in July. You know, we're in June, we have less than a month left in this quarter, and we're going to start getting this economic data in July and August. If companies are going to really disappoint to the downside and they haven't given guidance to prepare us for that, that could really make a market really shake, and that could really cause VIX to spike. So I think you're going to see companies, and we've already seen a handful of companies revise down on profit margins, revise down on what they believe earnings will be. So that's number two, as in regards to earnings. The third is the consumer, okay? You're looking at gas prices that continue to stay at extremely high levels, food costs at really high levels, and just those two components. I don't have to get into the other inflationary data, but just those two components alone puts the consumer in a very tough position financially. And so I don't see how the consumer this summer has the extra money or the discretionary income to spend on things like they did last year. And so I think you're going to see quite a bit of demand destruction on the consumer side, because unfortunately they're going to do everything they can to support their family with the necessities that they need to maintain their standard of living. You're starting to already see credit card debt is creeping up. Some of the credit card companies are starting to see a small uptick in payments that are beyond 30 days late. So these are just small things right now that are raising red flags to us that we think is only going to get worse. So you have a strong dollar that's hurting multinationals. You have inflation that is hurting the consumer. You have earnings revisions, in our opinion, are going to continue to get worse and worse and worse, and the data is going to really reflect that in July and August. And on top of all of those things, we have a Federal Reserve that is in a position now where it looks like, or at least what they're telling us is, they are going to aggressively tighten during this economic slowdown. So we could see 50 basis point rate hike in June. We could potentially see another 50 basis points in July. So the question you have to ask yourself as an investor, for you and your family, is how confident are you that the Federal Reserve is going to navigate a soft landing during one of the fastest slowdowns economically from a rate of change perspective that we have seen in quite a long time? In my 24-year career, when I've seen periods like this, and it's not very common that you'll see something like this, where there is just a lot of things that could go wrong versus what could go right, I believe for our clients, it behooves us to take a more cautious approach and wait and see what happens. Sometimes patience is the hardest thing as an investor to have, but I believe patience right now is something that is going to reward investors, because we believe we're going to see a market that is down much lower than where we are today, which could provide you some wonderful buying opportunities. And again, we could be completely wrong. We could be wrong on the consumer, we could be wrong on inflation, we could be wrong on the Fed, we could be wrong on everything. And if we're wrong, we'll come back on this station and tell you that we were wrong. But right now, for our clients' hard-earned assets, when we look at those dynamics that I just laid out for you, I just cannot, of conscious mind, take a lot of risk in this unknown period of time, because I would argue, and this is my last point I want to make, I would argue that many of us alive today have never seen a situation like this, where we have federal government deficits at all-time highs. We have a Federal Reserve that did everything they could to try to get us out of the pandemic using measures never used before. And now they have the tough task of trying to unwind this balance sheet and get this economy stable during an economic slowdown. That's not a seat I would like to be in. I don't envy their position at all. And that's why I believe the probability of a soft landing is extremely low. And I believe those that are patient are going to have better buying opportunities in the months ahead versus trying to jump in right now in the summer months. But at the end of the day, it's your portfolio. You know what your risk tolerance is. My job is to just share the data with you that we're looking at every single day, and for you to make an informed decision on what you think is best for you and your family. So I hope you got a lot of value out of today's video. I wish you and your family the best of luck, and make this a winning week. Thank you.